If you've ever tried building a dividend portfolio, you already know how overwhelming it can feel. Everyone online has a top 5 stocks list. The uncomfortable truth is that most dividend investors fail, not due to poor stock picks, but due to a lack of understanding. They chase high yields without understanding the risk, focus on short-term income instead of long-term sustainability. Today's video will break down the exact 5-step filtering process I use every time I consider a dividend stock. These filters separate reliable dividend stocks from ticking time bombs. Applying them consistently will transform your investing. By the end of this video, I'll show you 2 dividend monsters that meet all 5 criteria with flying colors. The company's balance sheet is like the foundation of a building. If it's weak, the entire structure is at risk of collapsing. If a company is drowning in debt, constantly refinancing, or relying on short-term loans, that's a massive red flag. When the economy turns, the first thing sacrificed is the dividend. Creditors come first, shareholders last. Look for companies with strong credit ratings, manageable leverage, and enough cash flow to support growth and dividends. A strong balance sheet isn't enough if the business model is irrelevant. Ask if it's essential and resistant to disruption. Stick to companies providing mission-critical services like energy infrastructure and regulated utilities. The third thing I scrutinize is the company's ability to actually pay the dividend from earnings. This sounds obvious, but you'd be surprised how many investors skip this step because they assume a payout is safe just because it's been paid consistently. Cash flow is king. If a company isn't generating enough free cash flow to cover its dividend comfortably, everything else is irrelevant. A company might have a strong balance sheet and a great business model, but if its payout ratio is 110%, that dividend is living on borrowed time. I like to see a company paying out well below 70% of its free cash flow, leaving plenty of room to reinvest, pay down debt, and absorb any short-term shocks. Lower payout ratios also give companies more flexibility. If they hit a rough patch, they don't have to cut the dividend. And if they're flush with cash, they can raise it. That flexibility is what keeps income steady over the long run. Once I'm satisfied that the dividend is well covered, I move on to growth. A static dividend might sound fine in theory. After all, income is income, but inflation doesn't care how consistent a payout is. If your dividend isn't growing, your purchasing power is shrinking. That's why I want to see companies with a track record of consistent dividend growth, ideally faster than inflation. Companies that grow their payouts year after year are usually disciplined with capital allocation, confident in their future cash flow, and committed to rewarding shareholders. But there's a second way to achieve this if growth is limited. Find companies with very high yields, say 8% or more, and reinvest the excess yourself. If you need 6% income and the stock pays 9%, reinvest the extra 3%, and you're effectively creating your own dividend growth. Either way, the goal is the same. Over time, your income stream should grow in real terms, not just nominal ones. The final filter is one that many investors overlook, but might be the most important: the people running the company. Even the best balance sheet, business model, and dividend policy can be wrecked by poor leadership. I want management teams that make smart capital allocation decisions, reinvest in high-return projects, avoid reckless acquisitions, and maintain a clear focus on long-term shareholder value. Are they chasing fads, or are they strategically positioning the company for the future? Are they leaning into major macro trends like artificial intelligence, renewable energy, or digital infrastructure, or stubbornly clinging to outdated revenue streams? I want to invest in companies with visionary leadership and a well-thought-out plan for the next decade, not just the next quarter. Because dividend investing is a long game, and you want management that's thinking just as long-term as you are. So those are the 5 pillars of my dividend investing strategy. A strong balance sheet ensures the company isn't crushed by debt. A durable, disruption-proof business model gives it staying power. Reliable cash flow and a safe payout ratio ensure the dividend is sustainable. Consistent growth protects you from inflation and compounds your wealth over time. And visionary management gives you confidence that the company is headed in the right direction. If a stock doesn't check all 5 of those boxes, I'm not interested, no matter how tempting the yield might be. But when a stock does meet all 5 criteria, that's when things get exciting. That's when you find the true dividend machines, companies that pay you reliably, grow your income steadily, and build real wealth over decades. And right now, there are 2 opportunities I'm especially excited about that pass every one of these tests with flying colors. These are the companies I'm investing in aggressively, the ones I believe can anchor a dividend portfolio for years to come. Let's start with the first one, and it's in a sector that's poised to benefit from one of the biggest technological revolutions of our lifetime: artificial intelligence. But we're not talking about flashy AI startups or speculative tech plays. We're talking about the infrastructure that powers the entire AI ecosystem, and why those companies are some of the most reliable dividend payers on the market today. Artificial intelligence is dominating headlines, and for good reason. It's already transforming industries, reshaping how businesses operate, and driving a once-in-a-generation demand for computing power, storage, and connectivity. But here's the thing most investors miss. You don't have to bet on the next hot AI startup to profit from this revolution. In fact, the smarter and often safer play is to invest in the companies building the physical backbone of the AI economy. These are the power grids, data centers, communication networks, and infrastructure providers without which AI simply cannot function. And the beauty of this approach is that these businesses don't just thrive when AI booms. They're essential in. The first reason I love this sector is financial strength. Many of the leading infrastructure companies are investment grade, meaning their balance sheets are rock solid and their cost of borrowing is low. They own tangible, mission-critical assets like power plants, transmission lines, and fiber networks. Assets that are expensive to build but difficult to replicate, which gives them a huge competitive moat. And because these companies typically have stable cash flows locked in through long-term contracts, they're able to maintain strong dividend coverage and still reinvest aggressively in growth projects. That combination of security and expansion is rare, and it's exactly what dividend investors should be looking for. Secondly, the business model here is about as defensive as it gets. Energy demand is growing, data usage is exploding, and the AI era will only accelerate both trends. Even in a recession, companies still need electricity, data centers still need to run, And the internet still needs to stay online. That means revenue is consistent, even when the broader economy struggles. And in many cases, these companies operate in regulated industries, which means their cash flows are not only stable, but also inflation adjusted, an underrated advantage that helps protect purchasing power. The third reason is dividend sustainability. Because these companies generate massive, predictable cash flows, they tend to have healthy payout ratios, often below 70%, which leaves plenty of room to reinvest, reduce debt, and grow the dividend. Many of them also have a track record of consistent dividend increases, often outpacing inflation. That's not just comforting, it's powerful. It means your income isn't just stable, it's compounding. And in dividend investing, compounding is where the real wealth is built. But here's what really excites me: the growth runway. We're still in the early innings of the AI infrastructure boom. Data center construction is skyrocketing. Electricity demand from AI alone is projected to double over the next decade. Entire new grids, networks, and facilities will need to be built to support the computational load of AI applications. The companies positioned at the center of this transformation aren't just going to survive, they're going to thrive. And as their cash flows grow, so will their dividends. One example that illustrates all of this is Brookfield Infrastructure Partners. This company owns and operates a global portfolio of critical infrastructure assets, everything from energy transmission networks to data centers. And its business model is built on long-term contracts and inflation-linked revenue. Brookfield has a strong balance sheet, a disciplined capital allocation strategy, and a history of consistent dividend growth. It's not the only player in this space, but it's a textbook example of the type of company that checks all 5 boxes. Another one worth mentioning is Brookfield Renewable Partners. As AI and cloud computing demand skyrocket, so will the need for sustainable power. Brookfield Renewable is one of the world's largest producers of hydro, wind, and solar energy, and it's aggressively expanding its portfolio to meet future demand. Like its infrastructure counterpart, it boasts a strong balance sheet, predictable cash flow, and a history of dividend growth. It's also benefiting from powerful macro trends like decarbonization and the global transition to clean energy, tailwinds that will likely accelerate in the years ahead. And if you prefer a diversified approach, there are even closed-end funds focused on infrastructure and utilities, like UTG or UTF, that give you broad exposure to companies benefiting from AI-related demand, while paying out attractive monthly distributions. These funds invest in regulated utilities, communication infrastructure, data centers, and renewable energy, essentially the entire ecosystem powering the digital economy. What ties all these opportunities together is that they're not speculative bets. They're not trying to predict which company will build the best AI model or which stock will 10x. They're selling the shovels in the AI gold rush, and they're getting paid no matter who wins. That's the kind of business model you want behind your dividend income. Durable, defensive, and built for the long term. Now, before we move on to the second dividend powerhouse, let's talk about one more advantage this sector has: dividend reliability during market chaos. When markets crash, many dividend stocks get crushed, not just in share price, but in payout reliability. But infrastructure plays often hold up better. Why? Because their revenues are non-discretionary. Companies can cut marketing budgets or delay product launches, but they can't stop paying for power, bandwidth, or server space. That means these businesses keep earning and keep paying even when everything else is falling apart. For a dividend investor, that's stability. Midstream companies sit at the heart of the global energy system. They don't drill for oil, they don't refine gasoline, and they don't sell electricity. Instead, they're the bridge that connects all those stages. They transport crude oil from wells to refineries, move natural gas to power plants and homes, and store and process energy products so they're ready to be used. Without these companies, the entire energy supply chain grinds to a halt. That means they operate mission-critical infrastructure, and mission-critical businesses are exactly the kind you want in your dividend portfolio. The first reason I'm such a fan of this sector is financial strength. Over the last decade, most midstream operators have dramatically cleaned up their balance sheets. After the oil price crashes of the mid-2010s, they learned a hard lesson about leverage. And today, many of the top players have investment-grade credit ratings, conservative debt levels, and rock-solid cash flow coverage. This financial discipline makes them far more resilient to commodity price swings and economic downturns. It also means their dividends are better protected because they're not scrambling to refinance debt or issue new equity just to stay afloat. The second big advantage is the nature of their business model. Midstream companies are essentially toll collectors. They get paid based on the volume of oil or gas they transport, store, or process, not the price of the commodity itself. So even if oil prices crash, pipelines still operate, gas still flows, and revenue keeps coming in. That volume-based model provides an incredible layer of stability, especially during volatile markets. It also means their earnings are less cyclical than those of exploration and production companies, which live and die by commodity prices. This stability translates directly into one of the most attractive features of midstream investing: high yields. Many of the leading midstream operators, names like Enterprise Products Partners, Energy Transfer, and Williams Companies, currently offer dividend yields in the 7% to 9% range. And these aren't shaky payouts from risky small caps. These are established, multi-billion-dollar businesses with decades of operating history and track records of rewarding shareholders. Even midstream-focused ETFs and funds like AMLP and MLPA yield around 8%, and they've been steadily increasing those payouts over the past few years. That's the kind of income stream that can anchor a portfolio. Another thing I love about this sector is how much cash they retain even after paying dividends. Many midstream companies have payout ratios below 70% and some as low as 50%. That means they're not only comfortably covering their distributions, they're also reinvesting heavily in growth projects. These include expanding pipeline capacity, building new storage facilities, or entering adjacent markets like natural gas liquids and petrochemicals. These investments create a powerful cycle. New projects drive higher volumes. Higher volumes drive more revenue. And more revenue drives higher dividends. Over time, this snowball effect compounds your income without you having to lift a finger. But perhaps the most overlooked strength of midstream energy is the sheer number of macro tailwinds behind it right now. Let's start with natural gas. As the world transitions toward cleaner energy, natural gas is becoming the go-to bridge fuel. abundant, relatively clean, and essential for power generation. Demand is soaring both domestically and internationally, especially in Europe and Asia, where countries are trying to diversify away from coal and Russian gas. The US is rapidly expanding its LNG, liquefied natural gas, export capacity to meet that demand. And every additional export terminal means more pipelines, more storage, and more processing, all of which benefit midstream operators. There's also the reindustrialization trend happening in North America. After decades of offshoring, manufacturing is returning to US soil, and that requires massive amounts of reliable, affordable energy. Chemical plants, semiconductor fabs, and steel mills all need natural gas and oil products to operate. And again, midstream companies are the ones transporting those resources. On top of that, geopolitical shifts are increasing global energy trade flows, and the US is becoming one of the world's top exporters of oil, gas, and refined products. Every barrel exported has to travel through pipelines and terminals, which means more revenue for midstream infrastructure. The surge in AI data center construction isn't just boosting demand for electricity, it's also driving up demand for natural gas. Midstream checks every box from our original 5 filters: financial strength, defensive business model, conservative dividend coverage, steady growth, and strong management. Midstream is often ignored by retail investors, making valuations attractive. High income with potential for capital appreciation abounds. 2 sectors stand out as dividend machines: AI infrastructure and midstream energy. Both share strong fundamentals and sustainability. Evaluate your portfolio against those 5 critical filters. Reconsider if your companies don't pass. Celebrate if they do. You're building wealth effectively. If this breakdown helped you, like, subscribe, and comment your favorite dividend stock. The time to build wealth is now.